Now, investors are witnessing a major shift as capital moves away from the US markets, largely driven by a global trade war and China's rise in technology. European markets are thriving, with stocks soaring nearly 9%. The S&P 500 struggling with a 1.8% dip this year. The dollar's appeal also diminishing as Europe and China ramp up spending to bolster their own economies. With emerging tech companies in China gaining ground, the landscape of global investment is quickly evolving. So we'll ask Kyle Rodder from Capital.com about this. Kyle, when it comes to investing, America, there's always been this saying, always bet on America. But given the uncertainty that Donald Trump is creating at the moment, do you think investors are right looking elsewhere, and are they?
Yeah, there's a couple of factors here, and some of it precedes and isn't, directly related to the Trump administration. One thing that we have seen recently is that there has been this kind of move out of really expensive US equities. We're outperforming the rest of the world for the last couple of years into cheaper areas of the global stock market, areas that you might say are more attractive value. China's a great example of this, and this is the technology story that since we had the DeepSeek breakthrough a couple of months ago, subsequently signs that the Chinese government is more willing to entertain private enterprise as, a sort of strategic as well as economic tool. A great example is, bringing Jack Ma back into the fold. You're just getting flow coming out of some of those expensive US names and going into, for example, Chinese technology names, which are relatively cheap, and all of a sudden the risk reward looks a little bit better. The story when it comes to Europe is fascinating, because what we've seen over the last few days, and this is in direct response to US foreign policy, is that there is a kind of galvanization going on within Europe to collectively pull together to enhance military spending and defense capabilities. And in particular, the Germans have announced significant packages to try and invest in its defense capabilities, which, although is mostly going to be directed into those industries that aren't targeted at, obviously that militarization, it is still on the aggregate a very significant fiscal boost, because they're going to start using their very, very strong balance sheet. The Germans haven't done this for decades, have been criticized for not doing this for decades for a number of reasons, but they're going to use that to effectively stimulate the economy. And all of a sudden we've got this money going into Europe instead. So it's not necessarily a condemnation of American assets. In fact, American assets have beaten the rest of the world for the last couple of years. But this is just a recognition that now there's better opportunities perhaps elsewhere, and investors are balancing their books away from those overweight US positions towards what were fairly underweight positions in Europe and Asia.
I also think about the Ukraine war and Russia essentially being kicked to the curb as a result financially and from the economic community, and then the emergence of BRICS and the talk about the US dollar obviously not being as important in parts of the world or used as much. Is that having an impact now as well?
To an extent. So there's a really good distinction, I think, when we talk about the US dollar in particular, and the sort of reserve currency status, is that there's the US dollar, which is used largely for payments, and that's a discussion about sort of how we move money around the world. And then there's the other discussion about the reserve assets and what's being used as sort of safe haven for a lot of global central banks, fund managers, and what have you. And that's less about US dollars and actually more about US treasuries, which is US government debt. When we talk about China and a potentially weaponization of the BRIC system, or moving away from the US dollar, what we're actually talking about is China moving away from putting its very ample US dollar reserves, which it receives because it's obviously an export-driven economy. It gets lots of money coming in, lots of US dollars coming in because it sells lots of stuff to the rest of the world. And rather than putting that into US treasuries, it's putting that into other assets, in particular gold, which marginally speaking weakens the US dollar, also puts upward pressure on US interest rates, means that the US can't fund itself as cheaply. That's concerning for the US because the US is running really, really lax fiscal policy, and it wants to fund itself in the cheapest possible way. The US dollar system, as it relates to payments, is still fairly robust because it's still considered the most advanced, robust kind of system. Again, it could be impacted a little bit because of fears of sanctions. Russia got pulled out of that kind of system more or less when it invaded Ukraine, so people want to find other ways of being able to make payments. But the dollar payment system is fairly resilient still, because businesses and consumers like to use the US dollar and the existing infrastructure. But that question about treasuries and how the US funds itself, I think that's the bigger issue, and at the risk of being potentially weaponized by places like China, which own a lot of US government debt.
The interesting thing is that Donald Trump has a war on government debt. We're seeing that with Doge. We saw that during his speech as well. He said that any money that we're saving should be going on paying down our debt. We have so much of it as well. Do you think the investors moving money out of the US is a temporary measure because they're waiting to see whether things like the tariffs and Donald Trump's Doge will actually have the positive benefit that Donald Trump says will happen? But at the moment, there's that uncertainty. So is this just a temporary move until whatever Trump's planning actually comes to fruition for investors?
I would say that the investors think that either he's lying or basically ignorant about how public finances works, really on the basis that if you look at the package, or I should say the legislation that passed, I think it was the Senate, maybe it's even gone through both houses of Congress already, that is establishing the groundwork for some of the spending cuts, but more in particular, some of the tax cuts that are going to come through for households and businesses over the next few years. That'll add to the deficit by about $1 trillion. It'll add to the debt load by about $10 trillion. If most projections are, would suggest roughly numbers of this amount over the next 10 years. So what is actually being reflected in bond markets is that, oh my gosh, we've got a person in the White House that is not going to actually repair the budget. The legislation that is going to go to his desk tells us that that is the case. And as a result, bond prices have to move lower, interest rates have to move higher to discount the fact there's going to be more government debt floating around, and that probably you're going to have these greater inflationary impulses coming through as well because of that kind of looser fiscal settings. So I think that's what the markets are actually adjusting to. Yeah, there's they sort of talk about how much Doge is saving and where they're cutting spending, but if you look at things in totality, we're still seeing a Trump administration that's going to run fairly loose fiscal settings, that's going to run deeper deficits, larger debt. That's what the markets are really responding to.
Yep, there's only so many Politico subscriptions you can cut. Doesn't really make a massive dent to $1 trillion budgets. Shortfall. All right, KyleRyder, Capital.com, always appreciate your time. Thank you.
Thanks.